How's it going, everybody? Welcome in. Welcome in, everybody. We'll get started here in just a couple of minutes. How's everybody doing tonight? Nice. Happy to hear it. Doing good too, SK. Good to see you. Good to see you. Good to hear, Marcio. It's awesome. We'll get started here in just a couple of minutes. Just going to give everybody the chance to hop on in. Probably get going about 5 minutes after the hour. Yeah, SK. I'll probably have a screenshot of the book in one of these lectures. I pulled up six different lectures today. This one. A complete guide to volume price analysis. One of my favorites. It's nice and simple. Um, the annoying part is there's some typos in there, which kind of frustrates me, but it's a really good book. We're going to summarize the content of it tonight as part of our price action and volume lecture. So this should be a pretty good kind of high level introduction to this class or into this book. But we'll give it just a couple more minutes before we get started. We got a bunch to cover tonight. It should be pretty packed. I might be too ambitious with what I'm trying to do tonight, but we'll see. Any comments or questions on anything before we get into it? I know last week we did the kind of double header with the support resistance lecture and then the Q&A with River. How'd you guys feel about that? Were you guys able to make it out? And hopefully that provided maybe a different perspective a little bit and switch things up a bit. But yeah, how's everybody feeling so far? Yeah, you guys been able to keep up with the course up to this point? Can you have too many support and resistance lines on a chart? Yeah, it's a very interesting question. I would argue the answer is yes. And there's a couple of ways that I think about it. Like, for example, I think it comes down to preference. Like, for me, you'll kind of notice if we go back, I don't have many levels for these lower prices. Sometimes I have these kind of other drawing sets where I have separate levels, older kind of drawing sets that have these lower levels that I used to use a bit more frequently. Wow, that's actually kind of cool to look at. That's crazy. Anyway, um, I personally like to keep my charts pretty clean. So I like to keep levels only in areas that's like relevant to current price. So even some of these lower levels, kind of below 565, I might consider removing. But I personally like to keep the levels that I have on my charts basically strictly from the daily time frame. And then additionally, I only keep levels that are kind of close to the current price. And that definition of close is certainly subjective. Like, it could be 5 to 10% away from the current price. It could be 20% away from the current price. But fundamentally, I like to keep it kind of simple and just have those most important levels from the daily on my charts. And you should be able to see that kind of reflected on a lot of the charts that I have, at least at this point. The one kind of wild card, at least for me, is on SPX. I like to mark every 100 points. I don't know why. I just like to do it. So, I mean, SPX, I have a decent amount of levels, but it's just basically every 100 points. So it's nothing too groundbreaking here, but yeah, just the way that I like to do it. Does that answer your question, R? Exactly. Yeah. For the most part, it's going to be swing highs and swing lows for me. Yeah, you hit the nail right on the head. That's basically what I keep it to. Now, as a day trader, like somebody like River, he's going to have way more levels because, while these are the levels of most significance on the daily, right? You kind of drill down to the hourly a bit, and you got a pretty key level right here at 602, another important one at 605, another big one at 589 or 590. Yeah, another decently significant one at 597. So there's certainly many more levels to be, paid attention to, depending on the type of trade that you're looking at. But again, kind of as I mentioned, for me, as somebody who's more focused on kind of the higher time frames, multi-day at minimum trades, I keep it a bit simpler. Cool. All right, everybody. Well, a couple minutes after the hour, so I want to get it started a little bit here. Just as a kind of quick warning, actually, let me send out one more message and everybody know we're getting started to do that. Cool. Yeah, so kind of like I mentioned a little bit ago, this lecture is going to be all about price action and volume. And some of you may or may not know that I did a kind of mini course on volume price analysis probably about 6 months ago now, back I think in summer of 24. So it's been a couple months. That was a 5, I think, lecture series. And I think honestly, as part of this class, you all would be better served by me just kind of summarizing the high level points of this class rather than maybe the lectures that I had cobbled together in the past. So just so you know, it's going to be kind of my first time giving this specific lecture in this format. Obviously, the material is all here, but I'll have to kind of decide in real time what I want to skip, what I want to bypass. Anyway, big idea of tonight is we're going to cover the basics and as much as the advanced concepts as I possibly can fit in of volume price analysis. And with that, I think I have some pretty good definition of everything in here, so we'll get right into it. Just bear with me as we go through things. Like I mentioned, it's going to be pretty packed, but hopefully that's a good thing. Like I mentioned, this is going to be a bit more of an advanced class in the series at this point, but I think you guys are all ready for it. So any questions or comments that come up, just go ahead and throw them in the chat, and I'll get to them as soon as I can. All right. A couple things. Again, this is kind of a course that I've cobbled together just for tonight, so we're going to summarize it pretty quick. But if you're interested to see these at kind of the pace that they were originally delivered, they're all recorded. I'd have to kind of dig up the link myself. I think there's a playlist somewhere, but they're all recorded. They're all available to you, but I don't have the link directly on hand. Oh, and we did a VPA workshop as well. So let's talk about this. What is volume price analysis? And this is kind of a direct quote, I think, from Google, which is volume price analysis is a trading technique that combines the analysis of volume and price movements to understand market trends and predict future price actions. By examining the relationship between volume and price, traders can identify the strength or weakness of different price movements, reversals, and continuation patterns. And I'm going to kind of oops, why can I not escape? I'm going to kind of bounce back between the charts and the lectures, so hopefully it's not too chaotic. But we've covered these concepts kind of informally over the last few lectures, right? It's really, truly difficult to talk about technical analysis without mentioning either price or volume. I mean, fundamentally, it's impossible to talk about technical analysis without mentioning price. And we've talked a little bit about this in the candlesticks lecture, talking about, strong closes where, you want to see a strong bull bar with a close near the high on elevated volume. A strong bear bar would be a close near the lows on elevated volume. Those concepts that we've talked about in these classes before represent the fundamental kind of backbone of volume price analysis. And we'll cover those concepts tonight in a lot of detail, or at least in about as much detail as I possibly can. So I have to do this specific book service by giving it an acknowledgement at the beginning of this lecture. This book, A Complete Guide to Volume Price Analysis, it basically serves as kind of the fundamental backbone, or I could say maybe textbook for this lecture. I definitely didn't prepare these ideas on my own. These aren't concepts that I've dreamt up. These are, definitely tried, trusted, and true methods, over probably about 100 years of different kind of quotes and knowledge from different stock market operators. So a lot of cool kind of knowledge in this lecture that we'll talk about. I'll start with kind of going into the background and the history because I find it pretty interesting. And then we'll jump around and go to some of the laws of volume price analysis. So Just talking about a little bit of background here. Um, Generally speaking, over 100 years ago, stocks used to be traded based off of what was called the ticker tape. And you can kind of see how this is laid out here. On the top, you have a ticker of a stock, and on the bottom, you have the price of that stock and also the volume sometimes as well. So you can see this one looks like it traded, looks like 200 lots at $76. This one traded 200 lots at maybe 81 and a half. This one doesn't have the amount of volume. This is just showing us price, it looks like. So 45 and 3/4, 35 and 3/4. So it's a little bit jumbled. But basically, this represents the tape, right? This is where the idea and concept of the tape comes from. If we look at ES, right, the version of the tape now is a combination of time and sales and level twos. But that ticker tape represents what we now look at in time and sales, right? This used to be printed and faxed and God knows whatever else. I don't actually know how this machine even really worked, to be honest with you. But this is where stock trading really began. And the reason that this is significant is because these same concepts that existed with the creation of the market over 100 years ago still apply today. And I always kind of like to have this one phrase. If you learn nothing out of this lecture, the one thing that I want you to take away from it is that there's never anything new in the market. There has never been anything new. I mean, frankly, everything that's happened in the market has happened before. There's obviously kind of those one-off cases with, your GameStop and, COVID and that sort of thing. But fundamentally, the way price and volume move, it's not new anymore, right? It's the same thing that's been happening for hundreds of years, well, not hundreds of years, but over 100 years. And you could even zoom out and see this sort of same behavior if you zoom out on SPX, which is the S&P 500 index. And if we took a look at this over the period of, I don't know, say, 100 years real quick. Let me clean this up because this is kind of disgusting. And let's switch to the monthly. Fundamentally, right, price and volume moves the same way today as it did back in the 1930s, right? While things are a bit more liquid, if you look at this candle chart that I'm currently attempting to zoom in on, if I told you, look at this, and I said, tell me what stock this is, most of you would have basically no idea that this is from 1945. This is representing price action data from almost 100 years ago. And even zooming back closer, this is the Great Depression, right? If I showed you this chart right here, a lot of you would say, oh, that kind of looks like COVID, right? And if I showed you this right here, you'd say, oh, that kind of looks like 2008. And if I showed you this, oh, that kind of looks like 2022. And if I showed you this, oh, this might look like, 2016 to 2020, right? Nothing is new in the stock market. All these sort of behaviors, it's not new, right? And I mean, even you can see how kind of price is respecting these EMAs and longer term simple moving averages here. None of this is a new concept. So everything that we talk about in this specific lecture and even the other lectures, it's tried and true, right? We're not reinventing the wheel here. And there's a lot of kind of market technicians and people who might make you think that, they found some new concepts, but a lot of those people, in my opinion, are really just repackaging basically how things have always worked. So obviously today, compared to the ticker tape, we now have real-time price charts with basically sub-second accuracy showing exact prices and volume. So comparing it to the ticker tape, obviously the technology has significantly improved to the point where people like you and I can all be in this class and we can look at live price movements of basically any instrument in the financial market. I can look at S&P 500 futures. I can look at Bitcoin. I can look at the Dow Jones. I can look at oil, right? So with pretty much the click of a keyboard, I can see basically information on any commodity, any asset, which I'm assuming you guys all know. So, this is supposed to have a little bit of animation on here, but yeah, I had this little joke in here which says the concepts in this course series are only applicable to the following stocks, which is not true, right? The concepts that we talk about in this lecture and every lecture are truly applicable to every stock on every time frame for every type of trader. And this truly is the power of volume price analysis, right? It's a very simple concept, but super, super powerful because it literally works on anything. It's incredibly reliable. It's been around for over 100 years, made probably thousands of successful traders, and it's going to continue to do the same thing. So with that, I'm going to kind of move into the laws of volume price analysis. So with volume price analysis, there's kind of three main, I'll say, rules or pieces of guidance to be paying attention to. The first one is the law of supply and demand, which is something that we've kind of talked about before. And very simply put, When demand is greater than supply, prices will rise. When supply is greater than demand, prices will fall. So let's think about this in terms of the real world, right? Let's think about something that has a bit of a supply shock right now. The first thing that comes to my mind is eggs, right? There's, the whole bird flu situation or whatever the hell's going on. So the supply of eggs has decreased. However, demand for eggs has remained constant, right? It's not like it's gone up significantly, but the people that wanted eggs last month still probably want eggs this month too. And as a result, the price of that commodity has risen. And once we see that supply begin to increase, right, whatever flu or issue or God knows what issue is going on, but whenever that's resolved, right, supply is going to increase back to what it was before. Demand is going to continue to stay constant because the same people that wanted eggs before still want eggs now. Price is going to go back down. And that is truly exactly how the market behaves, right? For example, if we look at the oil and gas ETF, notice how in March of 2020, we saw a significant drop in this oil and gas ETF representing the price of oil and gas. Well, what could have possibly happened in March or April 2020, which would cause this ETF to drop 75%? Obviously, COVID, right? As the demand for gasoline goes down, well, the price of gas is going to go down as well. And as demand rebounds, the price goes up as well. Same idea with this watch market. I don't remember what the idea behind this one was, but I guess this is like some rare Rolex, I think, when I made this lecture. The supply of this is constant, I guess. I don't think they're making any more. And as people want more and more luxury watches in this specific model, well, the price goes up, right? There's a limited amount of supply. And as more people want them, more people enter the market, the price of these watches go up. I don't like this example as much. Did I leave any notes? No, I didn't even leave any notes for myself on that. That's the law of supply and demand. Very simple, right? It's a concept that we see all throughout our world, absolutely is still present in volume price analysis. The next one is cause and effect, and this is a bit more of an interesting one. A small amount of volume will generally only result in a small reaction in price. A large amount of volume will generally result in a large reaction in price. And volume is the cause, and price is the effect. Where volume are going to be our buyers and sellers, right? People getting into the marketplace and causing shifts in price, right? If we lose all buyers in the market, or buyers and sellers, well, price moves less, right? Just look at ES, right? Look at S&P 500 futures. And let's zoom out just over the last day, right? You'll notice very generally, very generally, let me clean this up a bit and remove some stuff off here, get a bit more clean. Very generally, right? As we move throughout the day, right? Market opens at 6:30. We got oh, that's not the tool that I wanted. We got about 1% increase in price on ES in the day. Then we swung down about 0.5%, swung back up another 0.5%, and then into the close dropped about 0.5%. Once the market closed, we have basically dropped 0.25% in almost the entire amount of time that the market's been open. And you'll notice volume has all but vanished, right? There's 0 people trading compared to the people that were trading intraday, which should very clearly illustrate to you all that when we have volume, we get volatility, right? If there's no volume, generally speaking, there's not going to be any volatility, right? Buyers and sellers are what cause the movements in price. Price will go nowhere if nobody's buying and selling, right? If you have I don't know, some super rare item, it's one of one, and you hold the only one. Well, if nobody's actively buying and selling, the price is whatever you say it is. So it's not really going to be much going on unless I say today the price is 10,000, tomorrow the price is 20,000, the next day the price is 5,000. AI companion, yeah, sure. I don't know what that is, but I'll let you start that. Oh, yeah, we'll see what AI companion does. I don't know what that means. Anyway, volume is the cause, price is the effect. And that's the second law of VPA. And you can kind of see, right, if we look back to this example on Tesla, let's see. Oh, I blocked it out. Largest buy volume in the entire year, right? If you look throughout this entire period, this buy bar was the most significant. Would you look at what happened after that, right? Price increased, price basically doubled from that point, right? And if we go back and look at this chart, Tesla, look where the point on that chart is. It's all the way back down here, right? Notice before every single one of these massive rallies, What happened before every single one of these massive rallies? What do all these rallies have in common? Here, 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 here. Every single one of these rallies was precluded by a massive increase in volume. And every single one of these drops, same thing, right? Record sell volume. Well, we declined almost 30%, massive drop, right? Here, a little bit of an anomaly, right? We got massive sell volume and basically went nowhere. It's going to be a bit different, right? It doesn't always work. It's not always perfect, but here, massively above average volume. Oh, would you look at that, right? Top was in. So fundamentally, without buyers and sellers, price will never be volatile, right? Another couple great examples, TEM, right? News of Nancy Pelosi buying came out, I don't know, a couple weeks ago, right? Or a week ago or something. I don't really know. Here, we got a massive move higher on record volume. Since that day, prices continued higher another 30%. Quantum computing. This was a big one. Look at this. 102 million volume on this name. Look back at the average volume on this name. The average volume in an entire week for this company before that, I'll say the most volume in an entire week for this company was 40 million. Then all of a sudden, you get 400 million, 10x volume in 1 week. The problem is that when large institutions turn around and decide to buy an asset or sell an asset, it's like throwing, I don't even know, it's like trying to hold a beach ball underwater, right? Or parking a car in a bathtub, right? The amount of water that's displaced when you're trying to do that makes it incredibly obvious that something's going on under the surface, right? Or even for another example, if you try and put, a 50-pound dumbbell in a pond and you drop it down from 5 feet above, it's going to splash, right? And it's going to be pretty obvious that something fell into the pond. If you drop a leaf onto the pond, there's not going to be much of a splash, right? You won't even know it's there. It happens all the time. But if somebody parks their car inside the pond or launches their car off a ramp and splashes it into the pond, well, it's going to be pretty damn obvious, right? And this is what volume price analysis shows us. Very simple concept. It truly is very simple. All we're doing is looking at volume far above average. Then we're looking at the reaction in price. Does it correlate to that move in volume? In this case, we have a massive spread candlestick, right? When I say spread, we cover this in the candlesticks lecture. I'm talking about the distance between the high and low or open and close of the bar. The average spread is about 10 cents on this name, probably less. Then all of a sudden, we get a basically $1.50 spread on 10, 20x average volume. If that isn't a slap in the face for each and every one of you to pay attention to something, I really can't tell you what is, right? I really can't. And there's so many of these examples recently. Again, Tesla, we covered. Let's think, probably Meta is a good one recently, right? Just a couple days ago on their earnings report. Again, reasonably above average volume. This is before earnings. So again, bit of a grain of salt here, right? I'm not saying that this volume price analysis will show you what's going to happen on earnings. So bit of a kind of red flag here. However, far above average volume, we've continued significantly higher. Netflix, right? I mean, this is just absolutely textbook, right? Literally every single spike in volume corresponds to a massive move. Here, massive spike in volume, price moves lower. This one, bit of an anomaly, right? Massive spike in volume, we didn't end up moving lower. So it's not always perfect, right? And I'll be honest about that and very upfront. Nothing's always going to work 100% of the time. Here, we gap above prior highs on massive volume, consolidate, then break out again on increasing volume. You shouldn't be surprised that we never came back to these prices. You truly shouldn't, right? These are concepts that happen over and over and over again. And these are the high probability trading environments that you should be using to learn from these lectures and search for, right? Because I could sit around and take a bunch of trades every day. Anybody can do that, right? Anybody can go on the S&P. Oops, I stopped sharing. Anybody can go on, any chart and start day trading and just take, whatever trade you feel like, right? I can get short here, long here, whatever, right? I'm in the business of finding high probability market environments and taking advantage of that, right? Because once we're able to build conviction and once we're able to have a true understanding and confidence about what we think will happen, it's never perfect, right? We never know for sure. But once we have a very strong set of probabilities and reasons why we're going to be correct, it makes it a whole lot easier to have conviction to stay in that trade, right? And these are concepts, again, you see time and time again. I mean, so many times recently on the S&P, right? Here, 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 here. I mean, I practically memorize them at this point, right? Every single bottom and every single top has high volume nearby. I mean, backtest it, right? Every single low and every single high basically has some amount of above average volume near or at that exact spot. This is a bit of a kind of difference, right? No high volume here until we started to break down. But every single top and every single bottom, generally speaking, is going to have this amount of significantly above average volume. I will take a look at that in a little bit, Alexander. Yeah, this will be posted in the group for sure. Helmy says, can we know if there's huge volume coming? No, but you don't need to, right? You shouldn't be in the game of predicting in the market, right? The people who predict in the market are the ones who are creating these spikes of volume. All we can do as traders is react to that, right? There's no reason for us to say, ooh, I predict that there's going to be large volume at this specific level. While I may have a level of support or a level of resistance in that area, I shouldn't be, putting all my chips on the table just because I think, some volume is going to show up here. Maybe I could start a small starter position, right? I could try some longs here at this level if I think, for some reason this is going to hold. If I have this level and I say, yeah, this might hold. But you shouldn't be putting all your chips on the table when you don't have the market carving out those bottoms for you, right? There's people who trade every minute, every hour of every day. That's not me. There's absolutely no reason for me to sit around and predict what's going to happen. I'd much rather let the market participants do all the hard work, carve out the top for me, carve out the bottom, create that breakout, set that retest up. Then I'll take action, right? I don't need to be first into a trade, and I don't need to be getting out of the bottom or getting into the bottom and selling at the top. Nobody should have that expectation, right? I'm looking to catch the bulk of the move in the best, highest quality setups possible. Last law of volume price analysis is effort versus result. And I think this is Newton's third law. Hopefully, do I have it in my notes? No, I don't have that in my notes either. I think this is Newton's third law, which says every action must have an equal and opposite reaction. So generally, you should expect, when you see high volume, you should expect a large change in price. When volume is low, you should expect small or no change in price. But this doesn't always occur, right? There's going to be times when we have high volume and no change in price, or low volume and a massive change in price, which is called a VPA anomaly, which could be a bit of a red flag for us to kind of take a step back and really evaluate where the situation is at. So I think, let's see, was this an example? I don't remember. I don't think so. Okay, I think this is pretty good for today. This is kind of funny. Yeah, I'll let you guys look at that for a second. I love the stock photos. All right, let's move on to the next part of this lecture. I know I'm absolutely blowing through this. I can hear myself how fast I'm talking, and it's bothering me, but I feel like I don't have a choice. How's everybody doing so far? I see this question from JJ in the chat. I'll take a look at that. How's everybody doing? Am I going too fast? Trying to cram it all in? What do you guys think? JJ, is volume and liquidity the same thing? Technically, no. I think they're used a lot as synonyms, but technically liquidity is the kind of ease of being able to buy and sell an asset, which doesn't necessarily need to correspond to volume. Like something like Berk B or Berk A, Berkshire Hathaway. Let's see, what's that ticker? Is it even going to load? I don't know. Anyway, Berk A is like a, what? Am I not? There we go. Berkshire Hathaway is a $700,000 stock. And it's pretty easy to buy and sell. I mean, it doesn't have much volume. It's got 40, 18, 20, 30 volume, but it's got good liquidity, right? People are interested in it. Not many people buying and selling it, but people are interested in it. So yeah, again, This is a wild one. I don't know how many of you guys have seen this before, but definitely a wild one. But yeah, it's not something. Look at that, nice. Anyway, I would say volume and liquidity are two different concepts, but certainly can kind of course they can be used as synonyms. Yeah. All right, let's move on to what was the second lecture. Okay, yeah. So let's talk a little bit about some specific examples, right? This is an example of volume validating price. If this bar right here, this red line, is our average volume, this is above average volume, and you can see we have a nice bull bar closing near its high. We're getting a widespread candle. So this is an example of volume validating price. We get a big move in the candle, and we have a nice kind of above average volume bar. This is another example of volume validating price, where we have a small spread candle and below average volume, right? There's nothing wrong with this. We shouldn't expect big moves on low volume. We should expect big moves on high volume, right? Pretty simple. So in this specific case, right, if we have below average volume, we should expect a small candlestick spread. Average volume and above average volume is where we should start to expect that candlestick spread increase in size. And just comparing these two examples, I'll just stretch them all out so we can see it all here. If you compare the candles to the volume, these three above average candles, for the most part, have above average differences in price, right? Our biggest volume bar here corresponds to our biggest change in price, right? Our biggest candlestick. Here we have a big candlestick and a nice big gap down, so that works. Here we have a really big above average bar, but a pretty tiny average bar, right? We have basically two candlesticks that are about the exact same size, yet volume doubles, right? So that's going to be an example of an anomaly. We'll talk about that. So a volume price anomaly is when the two don't align. So if we have something like above average volume in a small candlestick spread, that's going to be an anomaly. So this is an example of a volume price anomaly, right? We have a massive candlestick spread and below average volume. That's an anomaly. Here we have a small spread and above average volume. Same idea. That's an anomaly. Putting these concepts together a little bit, here, for example, we have the spread of candlesticks increasing in size. Volume rises as price goes higher. Right? This makes sense. Same concept here, right? The spread of these candlesticks is increasing. Volume rises. Right? This makes sense, right? Volume and price are agreeing. This isn't a signal for anything, right? This is normal, what you should expect out of price action. Here, a little bit of a difference, right? We have price increasing. We have the spread of the candlesticks increasing, but volume starts to decrease. So that's kind of weird. And same idea, except the opposite, right? We have the spread of the candlesticks increasing, price is decreasing, yet volume's dropping off, right? So there's not more people selling as price goes lower. And Adrian asks, what's the reason behind an anomaly, right? I can't explain to you specifically why these occur, right? We'll never know, right? We don't know why less people decide to buy as price goes higher, or why less people decide to sell as price goes higher, or vice versa. However, the important thing for us to understand when we identify these anomalies is these can be treated as a potential signal, right? When we see these volume price anomalies, this should be a reason for us to start being a bit more cautious, right? We want to be a little bit more cautious, right? Price and volume aren't quite behaving the way that we would expect. And I think this should be covered in the next lecture. Yeah, so let's move on to this one. We're blowing through it. That was good. We got through that one quick. So, we were supposed to discuss in that PowerPoint the importance of monitoring volume during a breakout or a test of a key level, right? And let's just go into this example. Here, for example, let's say there's kind of some area of resistance up at this level, right? What we wouldn't want to see is this, a massive amount of sellers stepping in right at this level, right? It's not always super reasonable for us to expect to just blast right through every resistance level. But what we definitely don't want to see on any retest is a significant amount of sellers stepping in at that same spot. Like, for example, if you take a look at the S&P, go to the hourly. This is not what we want to see when we're testing a breakout, right? A little bit of a double top area, right? So not perfect. But as we come and test this breakout area, we see a massive amount of sellers beginning to step in, even here as well, right? Above average amounts of sellers. This is not something that you want to see if you're looking for a breakout, right? You want to see those buyers remaining in control. right? We don't want to see those sellers stepping in. And obviously, this was kind of news related and we continued significantly lower after the selling stepped in. But this absolutely remains true in a lot of different assets, right? So there's a couple of things that we would like to see. Here, let's just talk a little bit about the kind of ideal breakout, I'll say. Let's see if I can find one maybe. I think probably, let's see, Roblox probably is a decent example. Yeah, this is decent. Maybe the weekly looks a bit better. Yeah, perfect. Actually, let's go back to that. Okay, so I have this level identified here. Well, a couple different examples, but we'll focus on this one here because this is a bit more textbook than that. Still decent, but not quite as perfect. A little bit sketchier there. Anyway, right, looking at this $60 level, this was the lows of Roblox's IPO. And you'll notice as we come up and test this level, you can start to see the amount of buyers stepping out of the market, right? We're seeing less buyers as we keep testing this level, which that's going to be a volume price anomaly, right? It's a reason for us to say, okay, this name probably needs a little bit more rest. It needs a little bit more time to consolidate. This is the retest, right? Here is that red bar, that first sign of bears trying to take control. And look at the volume on that. This is the lowest weekly selling volume in 3 years. Nobody wants to sell. There's no sellers, right? Would you short this? If you see price coming into this key level, right? This is a really important level, but there's not a soul in the market who's interested in selling compared to the average, right? You can see what it's like when there's sellers in Roblox, right? Here, even here, and here. But here, there's no sellers, right? So this is going to be a very high quality kind of breakout retest or consolidation before a breakout, right? Super common pattern here where we come up to this breakout level and start to consolidate on declining volume, right? Buyers kind of step out of the marketplace a bit as we consolidate. And then we see the first time sellers really step in, there's basically nobody, right? And then once we start to break out, we see that volume begin to rise once again, right? As price starts to break out through these key levels, we see that increase in volume, right? Very nice pattern there. And I will openly admit, right, this one is a little bit less ideal here, right? This move here, right around this 54 area, the selling volume is a bit elevated. And again, I'll be the first to kind of identify that. But also, this is a bit of an anomaly as well for a different reason, right? If we take a look at this week here, we have massively above average buying volume. And look at the spread in this bar, right? This candle goes from 42 at the open to 52 at the close. It's about a 20% increase in asset price in a single week. The next time we have volume like that is basically the next 3 weeks. So on 1 week of this amount of buying volume, we increased 20%. On 3 weeks of that same amount of selling volume, we basically dropped 4% at the close. That's going to be a bit of an anomaly, right? This is that game of tug of war where we're seeing sellers put up a significant effort based on that volume, right? We're seeing really far above average volume. Sellers are trying very hard to make things happen, except nothing's really going on, right? It's like putting your gas pedal to the mat with the e-brake on. Nothing really happens, right? You kind of feel your car lurch a little bit, and then all of a sudden, nothing happens. It's exactly what you're seeing here, right? Sellers are giving it their all on this retest, yet price really didn't move, right? It dropped 4%. When buyers put in that much effort, they move price 20%. Now when sellers try it, they basically do nothing. And you'll notice, you can look at this chart and see definitely some situations where it's not perfect, right? And this is the idea with all of our technical analysis concepts is that they're not always perfect, right? It's not like every single breakout and every single retest and everything is going to be, textbook, right? That's not how the market works. It's not that perfect. However, the ideas still certainly hold true. Man, we're flying through this. All right, let's see what else I have in here. Oh, look at those AI pictures. I don't think I want to talk about that right now. Yeah, I'll probably, this is really important. I think I'll spend, let's see. Sorry, I didn't study these before the lecture. Okay. All right, I think I know what I want to do. I want to spend the rest of the time talking about um, accumulation and distribution. Um, yeah, let me refocus a little bit. Do you guys have any questions, comments, concerns that you want me to cover? I'll probably try and take it slow and talk about this concept for the rest of the lecture because I think it's super applicable and a really nice way to apply the concepts of volume price analysis. How you guys feeling so far? I know we're absolutely blowing through it, but it feels like it's going okay. Adrian's doing good. Okay, cool. Awesome. All right, let's keep it going. So this is one of my favorite concepts that this kind of idea of volume price analysis encapsulates. Generally speaking, the way that I like to start this one out is, and I'll present this kind of more officially. We'll do this nicely. Think of what it takes to empty and fill a warehouse, right? When you're filling a brand new warehouse, you got all your shelves, they're all empty, they're ready to go, and you want to get your product in there, right? And you want to fill that warehouse quick, right? Once you open up a new warehouse, and I'm not assuming everybody can relate to this, I'm probably assuming that a lot of people can't specifically relate to this. I know I can't, but if you were a business owner and you wanted to, take advantage of your new warehouse, you're going to want to fill that warehouse with product basically as soon as possible once it gets to the price that you're looking for. So let's say, for example, I want to, do some kind of drop shipping, right? I want to buy something and I want to resell it for a higher price. Well, if I'm doing that, right, I'm going to want to buy that asset for a price that I think is fair, that makes sense. So if I'm, buying and reselling, let's say computers, right? I want to buy and resell Dell computers for whatever reason. What I'll probably do is I'll wait for those Dell computers to either be in some reasonable price range, or I'll wait till something kind of very interesting happens with Dell computers. Maybe I'll start to realize that the market really is starting to like these Dell computers, right? I need to find a way to start selling these Dell computers to help maximize my business, right? This is what Amazon might do or Costco might do, right? They're monitoring the market and they're seeing, okay, what are people most interested in? Are people interested in eggs? Are they interested in Xboxes? Are they interested in backyard equipment? What should I stock up and prepare to sell to consumers? It might not seem like it, but market makers, large funds, institutions that trade stocks are going through similar processes, right? They're evaluating stocks that are publicly traded on the marketplace, and they're saying, okay, NVIDIA, are you currently at a good price where I want to buy large amounts of you right now? Okay, Apple, are you currently planning on doing something different that maybe the market isn't picking up yet? Do I understand something about this stock that maybe the rest of the market doesn't? Or is the valuation just generally cheap, in my opinion, right? Whatever analysis am I doing, whatever proprietary things that I'm looking at a given stock, is it cheap in whatever I look at, right? So as a large trading entity, right, you're looking at stocks that are either at a good value, right, or they're in high demand, or generally you think you can make money on it by buying at this price, right? That's why people buy and sell stocks, right? Same reason you guys are buying and selling option contracts. You're buying it at a price because you think you're going to be able to sell it for a higher price for whatever reason, right? Everybody's thinking the same way. So when that warehouse is empty, and excuse my AI photos, I got these a couple months ago, so they're pretty rough. But again, when that warehouse is empty, right, you got to make a lot of effort to fill a warehouse this large to get it looking more like the picture on the left, right? There's a lot of inventory that you need to fill up your shelves with in order to get that thing fully operating at capacity. So as a result, stocks are accumulated over a longer period, right? You're not going to be able to fill a warehouse like that up instantly. If you think about it, if I wanted to go buy, let's say, 100,000 Dell computers, and I just placed an order on Amazon for 100,000 Dell computers, well, it's probably not going to be very easy for them to fulfill, right? They're probably going to have me negotiate some shipping agreement. There's probably going to be some pricing that I need to figure out with them. It's going to be a headache, right? If I want to buy that much from something that really isn't meant to sell that many Dell computers to me at a single time. So the same principle applies to stocks, right? If I wanted to just go and buy 300,000 shares of something, oh, the price might slightly change, right? And 300,000 is actually a low amount. But let's say, for example, I want to go buy 20 million shares of NVIDIA and I want to do it right now at this price. Well, NVIDIA might trade, basically 100 million shares in a single day. So if I buy 20 million shares, I might have an impact on the price. And forgetting about, some regulations that, you can't be manipulating the market and that sort of thing. You can't have too significant of an impact, blah, 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 right? Trading firms are trying to get filled on their investments at a specific price range, right? They want to buy NVIDIA at 100. They don't want it at 110. They don't want it at 120. They want to buy at 100 for whatever reason, right? Again, we don't know exactly why they're buying and selling, but we know they want to buy at this area. And maybe they can accept buying at 101 or 99 or 102.50, but in general, they want to get filled in that specific area. And as a result, that might take a very long time to do. And that kind of buying campaign is going to be broken up over a long period of time, where that firm is buying in smaller chunks. I mean, fundamentally, they're still large, but they're buying in maybe smaller chunks than they would like to. And you can see here in this specific example, we have about double the average volume on these kind of highlighted bars here. And if this was done maybe more aggressively, like they started buying, immediately with all of the size that they were going to allocate, they'd probably have some kind of immediate impact on price, right? If I wanted to buy all these shares on the same day, well, price would probably start moving higher, and then I wouldn't be able to get the shares at the price that I wanted, and all of a sudden my trade's kind of messed up, right? It's not really how I planned it out to work, and I need to break this up over more. And this is a concept that we probably can't really relate to as much, right? We're not kind of throwing around tens and hundreds of billions of dollars that we need to allocate, but you could probably imagine the fact that when you're trying to trade with that much money, it can be difficult to get filled on your different purchases. So these periods can be broken up over a long amount of time, where a firm or multiple firms are buying and selling a given asset over a massive amount of time. And this is referred to as the accumulation phase. The opposite is the distribution phase, where stocks are distributed by smart money at these higher or elevated prices. So you can kind of imagine the cycle here, right? A firm is going to start by accumulating these shares at what they might deem a low price. They might add to their position as price goes higher once they realize, it's working out for them. They have more conviction, whatever it might be. And then once price starts to get to the zone where they deem it's their price target, well, they're going to start offloading those shares, right? They're going to start deciding to sell. And this is called the distribution phase. And similar to the accumulation phase, this can't just be done in a single day, right? If I accumulate hundreds and hundreds of millions of shares over a year period, I can't just go sell them all in the same day, right? Again, I'm going to have that massive impact on price. So this needs to be done over time, right? Sometimes there's negotiations that go on with different parties, but fundamentally, I need to sell those shares over a long period of time, because if I decided to just sell them all in the same day, well, the price is going to drop significantly, and all of a sudden I'm not going to make the money that I'm supposed to, or I thought I was going to. So if I just extend that period a bit, I'll be able to sell at the price that I wanted to. Eventually price will go back up and reach it, and I'll be able to get all the profit that I thought out of it. So you guys might be wondering, well, where is this going, right? This starts kind of the introduction into a concept called stage analysis. And this concept specifically has been really, really relevant over the last few years. And the way this kind of concept is broken down is that whoever invented this or authored this or kind of put the pen to the paper to describe what happens here argues that stocks go through kind of four main stages, where stage one is going to be that accumulation phase. Stage two is going to be that kind of, I don't remember the actual name of it, to be honest. It's basically just an uptrend. Stage three is going to be that distribution phase. And stage 4 is basically a downtrend, right? Stocks are inherently cyclical. And this is, generally speaking, the path that all equities follow over time, right? It's not always going to look like this, where a name kind of bases for this long period, it triples and then gets cut in 75% back to where it started, right? It doesn't always round trip like that. It's certainly possible. And the way that this is kind of judged is by using this 40-week moving average. When price starts to trend above that 40-week moving average, and the 40-week moving average begins sloping to the upside, that's generally believed to be the state where we've exited that kind of stage 1 accumulation phase and entered stage 2. And once that 40-week begins sloping to the downside and price breaks below it, that's when we've generally been accepted to move into that stage 4 stage. And we've talked a lot about theory, and I want to kind of bring this back to some real examples. Roblox, funny enough, is an excellent one, right? Really, really excellent. You can see all the stages on this chart really clearly. I mean, very clearly, right? Check this out. Here's kind of our initial IPO phase, right? You could consider this maybe that first stage 1. Here is what you might consider stage 2, right? It was really brief, just massive uptrend, super quick. There wasn't much of a distribution phase, and we entered what you could call a stage 4, I guess. But this was all very quick, right? This was a new IPO, so it's not really going to always follow all the rules. Here, though, you should all be able to look and tell me that this looks pretty damn similar to this, right? Massive downtrend. All of a sudden, price stops moving, and we can see these little hints all throughout this base. All throughout this base, we see these little above average spikes of volume. But price doesn't set new lows, right? Even on these bear bars, we see that above average volume, price doesn't set new lows, right? Price doesn't go anywhere. It stops moving, basically. It starts to sit in this range. It starts to consolidate. This is stage 1. If we take a look at our 40-week moving average, let's go ahead and add that to the chart. Simple moving average. Make it thick so we can see it. Here's our 40-week moving average. This is when stage 1 began to end. We break above that 40-week moving average, and it starts to slope to the upside. We are now in stage 2. This is going to be one of the more ideal places to start focusing long on a given asset. You are at the beginning of an uptrend here. And notice, let's combine these concepts even further. Here's our swing high, right? Using support and resistance concepts. Here's our swing high, $54. Volume price analysis. We come into that level on rising buy volume. We consolidate on above average sell volume, but we don't really drop. We maintain above our prior level of resistance as well and retest it. Then we break back through our base on above average volume once again. Let's say you didn't get long on this candle. Let's say you didn't get long on this retest. Let's even say you didn't get long at this bar here. You damn well shouldn't be short, right? You have been given every single signal at this point that this thing is not going lower. Recapping, you have a 2 to 3 year base. Price did nothing for 3 years. Literally nothing. It didn't go anywhere. It was flat. Start of 2022 was here, and that's not exactly true. To the start of 2025, prices dropped 10%. In 3 years, the stock has done nothing. 10% is nothing, right? It's gone nowhere. That is a recipe for a massive move. Long-term base, break above prior resistance, retest of that prior resistance, volume back breakout of the most important level on this chart, besides this one now. Now this is the most important level. We traded right into it today. Probably wouldn't be long right there. Well, in this area, 54 is the most important level on the chart. There's no other way to put it, right? This is the swing high. And also it corresponds to this pretty critical low as well. This is stage analysis, right? This concept is repeated over and over and over again. I can pull up so many examples. Snow is one that's kind of in that same base right now. Robinhood, went through the same procedure, right? It looks the exact same. This one broke out of the base earlier, multiple trips back to that 40 moving average, but you can see it. I mean, you can see the base, right? Even a beautiful retest, they gave you another opportunity in August, right? PLTR, another example, right? Same idea, a little bit different of a base, but same concept. Tesla, a little bit messier, right? This doesn't always happen. We don't always get a super clean base. NVIDIA, a little bit more of an episodic pivot here, less of a just very clean base in this specific one. So important to note, we don't always get this, clean price action where it bases out in a nice little rectangle for us and it's real clear what's going on. We don't always get that, right? It's not always going to be the case. ARK, similar idea, right? Just starting to break out of this base here, right? Just kind of setting up this new potential move higher. Square, XYZ, same idea, doing the exact same thing, right? Setting up right on top of these pivots. Very, very similar look to it. I mean, you could go back and look at so many different names that have followed such a similar pattern. I think even AT&T, similar idea, kind of through this period, a little bit more aggressive, but similar idea, right? Maybe just a bit more compressed. Coca-Cola, not quite, but similar ideas. Anyway, point being, this idea, SPY is a great example of this too. A little bit wider of a base, same concept, right? This uptrend really started once we broke back above that 40 moving average and it started to slope upwards. And this is just the beginning, right? So when you're looking and paying attention to what these institutions are doing at the lows or highs of a chart and looking for these stages, you are getting some of the best entries that you could possibly get. Look at Hood, right? The institutions cannot hide when they're entering an asset. Look at this. It's very, very obvious to anybody with a set of eyes that people are not uninterested in this name. This matters to investors for whatever reason, right? It doesn't matter if they like the technicals. It doesn't matter if they like the fundamentals. It doesn't matter if they think they like the ticker or they like the color that the app is. All that matters is people with money want in. And that's what moves markets, right? Buyers and sellers, when they show up, that's what gets markets moving. And that's really the power of volume price analysis, right? Putting everything together here. This is all you really need, right? Identify some key levels, pay attention to volume at the lows and highs, pay attention to volume on breakouts and retests, and it will take you so much further in terms of finding higher quality and higher probability trades than basically anything else, in my opinion, right? Somebody could sell you an algorithm or some other BS that they conjure up, but you can't argue with this, right? Because this is real data. There's really no indicators. I mean, yeah, sure, the moving average, but there's no indicators involved here, right? It's price and volume. It's about as raw as it gets. This is the data that any technical indicator, literally anything, is based off of. It's price and volume. And if you can master this and you understand the basic concepts that we talked about today, it will set you miles ahead of even a lot of the traders who have been in the game for a couple of years, right? It's sad to say, but a lot of people just seem to think that this doesn't matter. And fundamentally, I mean, I don't agree with it, but to each their own. That's my spiel, everybody. How are we feeling? What's up, Ray? Thanks, Adrian. This moving average is the 40 simple moving average, 40 SMA. This is kind of most commonly used for this stage analysis concept. Any other comments or questions? We blew through 6-ish lectures of content in about 40 minutes, so it was a quick one. Can I do this? Yeah, you can. Well, obviously the chart has to kind of align, but basically, yeah, the answer is yes, right? This applies to all assets everything, right? This applies to everything. This is not unique to any specific stock. Yeah, these concepts apply to anything. Obviously, you're not always going to find these setups, right? There's not always going to be a nice perfect base. Week moving average, should you have that on your charts? Yeah, this is something that I wouldn't personally keep on my charts as kind of like a staple, having it every day. Um, personally, um, I would be more inclined to just have this on like a weekly basis, like when I'm looking at like reviewing charts on a weekly basis. This is something that I'd probably bring up. This is the weekly chart right here. When you're doing any stage analysis, that's got to be done on the weekly. Anything else I can cover for you guys before we call it for the night? You're looking at SPY. Yeah. So kind of like I mentioned, right? When I say you can implement it on every stock, I say these concepts are valid on every single stock. But just because they would work on every single stock doesn't mean that every single chart is going to set up in the same way, right? So while Hood has got a really tight, couple buck base here, not every stock is going to do the same thing, right? It's just fundamentally that every stock isn't going to behave with the exact same behavior. Institutions and buyers and sellers are buying in different manners, and sometimes stocks bottom a whole lot quicker than this. Like a counterexample, something like Meta, where there was literally no basing action. It was just a V bottom where we bottomed out and never looked back, and that was it. And now we basically 7x from that low of $100. Yeah, it fundamentally it depends. You have to look at the chart and see if the setup's there, right? But this concept applies to all charts. So if you are seeing some kind of basing action in a stage one base or topping action in a stage four base, it's 100% valid and you're 100% seeing things correctly. But just because these concepts exist doesn't mean you're always going to see it, right? The same mindset applies to something like a more typical pattern, like a bull flag, right? So just because a bull flag exists in the market doesn't mean that every stock is going to have one that you can look at, if that makes sense. Yes, that is true, chart writer. Um, yeah, sometimes there's things that aren't worth looking into too much. Like, for example, I 100% agree with you. The volume is tapering off lower. However, the price has also increased significantly. So, like, from a dollar amount standpoint, this amount of volume here is basically the same amount as this amount of volume here, right? Because the price is double and the volume is about half. So from a dollar standpoint, a total notional point of view, it's kind of about the same. And there's some nuance to it. Um, yeah, but it's a fair observation either way, chart writer. Yes, Ray. I know we had one question from somebody earlier that I didn't want to skip, but I just didn't want to cover it at the time. Alexander, is Alexander still here? Oh, he's not here. Okay, we'll skip that. Would that mean selling coming in the future? No, chart writer. So a volume anomaly or a volume price anomaly alone can't tell us that there's any specific, buying or selling to be taken place in the future. Um, Generally speaking, when we see those volume price anomalies, it's a reason for us to be cautious, but it's not a reason for us to make a decision on anything. And even on something like Meta, this specific example isn't something that I'd be too concerned with. Um, yeah, hopefully that helps. Cool. Unfortunately, no, Adrian. This is our only class in the beginner's course series on volume price anomalies, but I definitely go into more detail in the actual volume price lecture series. There's just only so much I could fit in tonight, so I had to kind of abbreviate things here and there. But if you send me a DM, I can try and dig that lecture up for you to send it across to you. Thanks, Joe. I appreciate it. Cool, guys. Well, that's gonna do it for tonight. But that's the end of it. All right, everybody. Well, I appreciate you guys all being here. Yeah, I hope to see you guys all in next week's lecture. Where can you find old lessons? Yeah, that's a good question. Basically, you can find all the old lessons in this latest lectures tab. So it's all going to be in here. So it has everything basically. Cool. All right. Well, thanks again, everybody. Appreciate you guys' time. This AI companion thing was kind of cool. I don't know if you guys, I was kind of trying it out in the background, but this is kind of cool. It gives you this like it basically like it actually is pretty accurate. It talks about everything that we talked about. Weird. Yeah, I've never seen that. I gotta take a screenshot of that. That's kind of cool. All right, guys. Appreciate you guys all being here. I will see you all in the next one. Adios, everyone.